The markets are going very crazy high right now. But what is the story behind, and how is it possible and able to see when is the high coming? Look at silver, look at gold, look at other markets. It is going up, up, up. Copper, anything else is running. Is it healthy? No, it isn't. And I give you a big explanation what is the way you can see when is the mark at the end. I am Tom Forward, I'm the champions maker like Patrick Nell. I'm somebody who teached people like Fabio Valentini, like Andrea Cimitan, and help them to become a successful trader. And when this is important to understand for you, how does it works? Listen to me. I translated this video with AI because I'm not a native English speaker, but I do my best. And let me hear if you like it. Thanks a lot.
Yes, the perfect way to use liquidity to find a smart trade. What should I pay attention to? The first thing you absolutely have to do is to thoroughly examine the key figures of the products you actually trade with. Because it doesn't help you at all if you think something is too high or too low right now, but you don't really have any genuine, meaningful ways to get significant information that shows you that's actually the case. There are two things you need to pay attention to. The first is, what is the average liquidity of a product? The second is, what does it look like right now? Is it much less? Is there no supply and demand anymore? Or is it much higher? Both topics are very, very interesting because if it's much lower, well, then simply no one is interested anymore. And then there's a high probability that the market will return to its average. But if it's much higher, as we currently see, for example, in gold and silver, then we need to think about what the story behind it is. And that's exactly what I want to show you today. I want to explain to you how you can read this for yourselves when you make trades. When does it make sense to look at this point? Maybe it's at the top now, or maybe it's still not the right time. So stay tuned, this is going to be really exciting for shorting the tops. And who isn't interested, for example, in understanding I have physical gold or silver, but is it really already too expensive? Should I sell it? Or much simpler? Can't I just hedge the whole thing and actually keep the physical asset? So let's take a deeper look into the market. Let's start here with a picture of the gold futures and first take a look at what the volume looks like at the bottom. I'm drawing here quite deliberately. The volume spikes are always a bit bigger. And a lot of buyers came in there. So I can immediately see there was a lot going on here. There was really a lot going on here. There was quite a bit happening here too. But here there was an extreme amount of activity, and here as well. What do I do in the next step? In the next step, I go ahead and extend these price ranges upwards. And then I can already see, okay, a lot was sold up there. But what happened before that? Take a look here. A lot of buyers. And what do we have right now? Right now we have this situation again. Of course, I don't know yet if the seller will show up now. But what's the story behind it? And that's something you absolutely have to understand. And it's exactly the same in day trading, in the short term. That's the key word. Hedging transactions. That means many large institutional investors are forced to buy or sell futures. And now you just need to know what's happening there. And that's what I want to explain to you because it's so important to first understand the logic behind it. Look, the moment a market, like here, for example, the gold futures, keeps rising and the market starts to push upwards out of this balance area, we very often see a strong increase in volume. This volume isn't created by us traders, but by so-called hedging transactions. Hedging. Why are people hedging here? It's a very simple story. Just imagine you produce watches. This might be a small example now. Automotive industry, batteries, and so on. And you need this raw material, and the fair prices you currently have, those are okay for you in this area. As long as your gold price doesn't go above 3,450, 3,500, you're fine with the production costs you have for the raw material you basically need to acquire. Now, of course, the question always comes up, why buy the future then? Very simple answer. The moment a market gets out of control, that is, breaks out of such a range, so-called hedging transactions occur. This essentially means that the essential industrial market participants, the corresponding hedgers and risk managers, who simply have to buy in order to continue securing fair prices at a fixed rate for themselves, will go ahead and purchase a standardized futures contract for the long term. And once they've bought it, in the amount that they currently need in physical gold volume, they are essentially at zero. This means for you, the market is at zero here. Now, you have to keep two things in mind. A, there are maturities for futures contracts which expire. And B, the second thing is you have to be absolutely clear about one thing. If the market now surges upward and prices continue to rise steadily, your hedging transaction is not at risk for the time being. But beware if a big player suddenly starts selling. Why? Let's go up here for a moment. You have your hedging transaction and you did a very good job, for example here. You executed your hedging transaction. That means this is your zero median. As long as the market is above this level, everything is cool for you because you bought the future, for example, at 3,600. And so your prices here are cool and fair. Now, it might even be the case that you achieved slightly higher prices, and that's not uncommon. That's the case. And you can see that exactly here. That means people had to make hedging transactions here in this price range. And if they have to do that, then there's a certain urgency behind it. And now the question always is, why are they doing this and what could happen afterwards? And I can tell you very clearly, the following is happening now. Now let's go ahead and say, here is the price at which this forced purchase to secure their position started. And now, if you observe closely, the market does exactly this, right here and right now. Please take a very careful look at this area. Look here, and look here. At this precise moment, we can see that an aggressive seller finally comes in to drive the price. Really aggressive. He must have a reason for doing this. And it's definitely not the hedger. Instead, it's someone else, a big player in the capital markets, maybe cashing out, a big institution or something like that. And now he goes and pushes the market down, maybe because he simply needs new liquidity for other things or something like that. I can tell you later how they do that. In any case, what happens now to our dear hedger? He has this one here, he has two options. Either he thinks, oh well, I'll just wait until the market reaches the expiration date because these are commodity futures contracts of 1 month, 3 months, depending on which future you bought, until it basically reaches its expiration date. And then everything will be fine. Or he gets into trouble here. And unfortunately, that's very often the case and leads to these selling movements. Then down here, and has to sell his hedging transactions again. And then that's how it goes. That means this dear trader who made his hedging transactions here suddenly finds himself underwater again. That means first he has a problem because he has to make hedging transactions. And then he has a problem because he made the hedging transactions at a really bad price level. And that's exactly what we're seeing a lot of right now. Let's take a quick look at the same thing in silver. And that's where it gets really exciting. This here was roughly the median of the volumes. Take a look here. What's being traded here right now is truly, truly huge. But now it gets even more interesting. Now just imagine here a contract. $52. Of course, not a whole contract, just 1 ounce. And what kind of turnover do we have here? Yes, let's call it turnover of 2. And here we have turnover. 3 times as much. But we have 3 times as much turnover at a price of 80. That means significantly more volume is being traded at higher prices. That means there is real urgency there. And now let's go even further. Now we're already twice as high. And believe me when I say this, the chances are exceptionally high that the global market will soon experience a very strong and volatile reaction right here. Because one thing is absolutely clear to everyone involved. If a massive volume of contracts are being traded at double this current price level, then that quite simply represents twice as much money flowing through the system. It is a significant shift that we must watch closely. And as a result, it's obviously a gigantic volume that's currently being traded here. So you can't compare this sales area and these sales with this average at twice such high prices. You just have to think about that logically for a moment. And that's why I can tell you, what are we waiting for now? We're waiting for the moment when large volumes break downward. You can project the price upward if you like. Where were the last big buyers? And then you'll see when the market goes below that. Then the probability is high that sales will increase. And then you have the big short. Boom. And that's exactly how you can use a very logical approach to recognize where the top is. It's not hard. You just have to think a little deeper and more logically about it. You can do exactly the same thing. Intraday. And then, of course, you can go even deeper into footprint charts and so on, where you can simply look at the liquidity. When exactly is there a big sell-off up here? That means, for example, when was there really heavy selling up here, really heavy, after there was heavy buying before, and now suddenly it's the end at the top. And then you have a price range here where you can watch what happens if we drop below it. And that's the moment where you're usually even in earlier than if you analyze the volume the way I just showed you. But more on that in the next video. If you like this, if it gave you a bit more awareness about what's currently happening in the capital markets, especially in gold and silver, but also in other futures, if you can adapt this 100% for yourself, then leave me a like. I hope you enjoyed it, but above all, I hope it gave you deep understanding for what's going on here right now. And you have the opportunity to see when it's time to make hedging transactions for your physical holdings. Or if you're a trader, maybe now you know better where you can start a cool trade. Thank you very much for your time.